to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Graffeo. Scarlett Fu, happy Monday. Happy M&A Monday in particular.
And also happy Monday with lots of political overtones. You've got France, you've got Japan, you've got the ongoing government shutdown.
An embarrassment of riches. Let's get to the biggest stories right now. In the more than $18 trillion global ETF industry, Japan, as Scarlett mentioned, preparing for its first female prime minister and a big political shift. We'll discuss with Rob Forsythand of Lazard on the impact on ETFs.
Plus, we're going to speak to Jamie Rush of Periscope Capital on identifying the companies that are creating the most buzz online, both good and bad.
And Vanguard's rivals are getting ready and getting their hands on the firm's unique fund structure after the SEC indicated it will allow Dimensional to do so. That's right, multi-share classes. We're going to get into that. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with the flows. Eric, what do you got?
Katie, Scarlett, thank you. Look, everything's at all-time highs. But enjoy it while it lasts, by the way. No need to get so angsty. It's good. Everything's up. SPY with $7.1 billion. That's a big bomb for it. Might be operational, not totally sure. IBIT right at the top. That's rare. IBIT and Bitcoin recently caught up to stocks and hitting all-time highs over the weekend. I'll go over more of that in a minute. Here's some junk bonds. Here's some Dow. Here's some financials. Here's more S&P. And here's some gold. This has been the story all year. You buy your U.S. stocks, but then you buy gold and Bitcoin for the, quote, debasement trade and as a little bit of a hedge. And that's generally been where the flows have gone all year. Let's look at the outflows this week. And there is some little bit of money coming out of equities here. IVV, IWM, small caps, again, you know, what is this, the 100th time that there's money coming in and it comes right back out. But small caps also, I believe, hit all-time highs recently, too. A little bit of money out of VU. This is semi, so not all totally bullish, but generally speaking, it's leaning that way. Now, let's look at IBIT. IBIT surged recently, both in performance and in those flows. It now has $98 billion in assets, so we're on watch to see when will it hit $100 billion. So here's a chart showing the fastest ETFs to hit $100 billion in the history of ETFs. So this is like 10,000 launches. IBIT at $98 billion is probably going to get there at 435, 436, somewhere in there days. The next fastest is 2,000 days, which is VU, which, as you know, is the biggest ETF in the world. So, Katie, 5 times faster than VU, pretty much, for IBIT. Just unbelievable.
It is just wild. Almost looks like a glitch on that chart. Eric, thank you. Joining our conversation now is Rob Forsythand. He is global head of ETFs over at Lazard, joining us on set. Great to see you again, Rob.
Good to see you. Thanks for having me back.
So we're going to get into your lineup, of course, and some new product news that you have today. But we have to start on the debasement trade, mostly because Eric demanded that we do so. There was an interesting report out from JP Morgan, analysts describing what we're seeing in IBIT and some other asset classes as well as basically the debasement trade, this surge for alternative stores of value. And I wonder, you know, when you look across the landscape, do you see signs of that going on?
I mean, you just saw it on the chart that Eric was sharing, right? IBIT as, I think, the second largest in terms of inflows this month. He's had GLD on the list as well. I definitely think that there's a bit of that centered around all of the fiscal and monetary policy uncertainty that we've experienced these last couple of months. At Lazard Asset Management, we tend to look at more inflation-adjusted traditional means of return. So one of the products that we launched actually today is our listed infrastructure strategy. Infrastructure assets have this tied kind of revenue and contract revenue stream directly linked towards inflation adjustment. And that's how we prefer to access it. I think the ETF industry, all shapes and sizes, the types of products, you can kind of gain that exposure any way you desire.
And one of the products you do have is also IDEQ, which is the Lazard International Dynamic Equity ETF. I wanted to get your take on some international developments, notably in Japan, with the surprise win by Sanae Takaichi as potentially the new next prime minister of Japan. She is seen very much as pro-fiscal stimulus, and we saw stocks surge in the wake of this news, the yen tumbling as well, and the JGB sinking. How does this change Japan as an investment destination for you?
You know, I think it's going to play out in the relatively kind of intermediate term. We have a Japanese equity portfolio in ETF form as well, ticker JPY. This is where I think active management really pays for itself. You have all this uncertainty. You don't know what the policy implications are going to be from the new prime minister. Is it going to be a retrenchment of kind of Abenomics? Is it going to be something new? I think as things work their way through, especially because it is so new, it was such a surprise, you want to give your money to an active manager that has kind of deep roots and research in the local markets, can make the decisions as those policy decisions are made.
Trivia question time, Katie. What is the biggest thematic ETF?
Oh my God, you could have told me you were going to ask that.
The answer is PAVE, which is an infrastructure ETF, which is probably why you launched an infrastructure ETF. Clearly, there's a lot of interest, but PAVE is up 26% annualized over the past 5 years. That's a lot. How much juice is left in the squeeze here, and what's the catalyst going forward when the government shut down and it seems like jobs are being cut?
Yeah, it's a great question. Our infrastructure team's been managing assets in this space for over 20 years now. We believe that investment in infrastructure is likely to continue. We're seeing somewhere north of $3 trillion invested in new infrastructure. The modernization of both airlines, toll roads, kind of core infrastructure, real estate, telecom, so on and so forth, is all going to continue. Even with the temporary shutdown, that funding is still going to be mandatory to kind of keep the economy modern. PAVE's asset base is massive. As you noted, the largest thematic ETF in marketplace right now. Taking an active approach here, we're really concentrated. We go really deep in these individual names. We rely on our deep expertise and specialization in this asset class.
Yeah, nearly $10 billion for PAVE. It's interesting to see you come out with an infrastructure ETF because typically when we talk about infrastructure nowadays, digital is before it. Digital infrastructure is sort of the talk of the moment. And when it comes to potential thematic ETFs, I just wonder what that process looks like, how you identify a theme and how you decide you have enough conviction in it that it should be a listed product.
It all starts with our research and our investment capabilities. The infrastructure strategy, as I mentioned, we've managed it in other forms, in other investment vehicles for over 20 years now. As it relates to technology infrastructure, as an example, we brought out Techie back in April, the last time I was with you all, and that strategy focused on the full AI stack, including some of the AI infrastructure names that you would expect to have in there. When we identify our strategies, like I said, it starts with our investment capabilities, starts with our deep heritage in research, fundamental bottom-up analysis, and identification of those themes occurs across this research apparatus. So we conduct, I think, close to 5,000 interviews with management of companies in which we invest on an annual basis, and that's where we really begin to identify themes that are taking place. Where's CapEx being spent? Where are there R&D breakthroughs? That's how we identify themes, and that's how we incorporate it into our product development process.
All right, trivia question number 2, but this time we planned for it. Katie, there are a lot of filings, ETF filings on Friday, right? How many?
Over 100?
Over 100 on Friday.
Help us out.
105 to be exact.
There we go.
Okay,
There we go.
105 to be exact.
Mind-blowing.
Okay. I mean, this is while the government is shut down as well. How does the shutdown, if it continues more than this week, start to affect ETF launches versus, say, IPOs?
I think it'll have more of an effect on new launches and new entrants into the marketplace. Those that have been there already that don't have to rely on exemptive relief for a new active trust or a new ETF trust, for that matter, should not be affected all that much. Where it actually might have some implications is on the new approval that you mentioned earlier on ETF share classes of existing funds. We saw the approval and a number of amended applications. We haven't amended ours yet, but we are in market with the initial application. That's likely where you might see some delays if the government shutdown were to continue.
Let's talk about the share classes because there's 70 or 80 firms wanting to do this. So everybody out there, whether you're in the industry or an investor, this is going to affect you. What's the roadmap here? You're going to have mutual funds. You're going to bolt on an ETF share class. And then is the goal to use the ETF to minimize taxes for the mutual fund? Or is it a tax-free way to switch to the ETF share class so you don't lose the investors?
We're hoping for the latter. We're going to have to kind of segregate the asset bases between the different share classes, but we're hoping that once it's kind of operationally ready, that you will be able to, as a taxable investor, transfer your holdings in a mutual fund share class into an ETF share class that will be bolted onto the fund structure once it's approved and operationally ready. I hone in on that operationally ready term because we're not there yet. Right. Many of the distribution platforms aren't ready for this yet either. So this is all kind of preamble, and I think there's a lot of work that needs to be done from a technology and infrastructure perspective before we can kind of get to that end state.
Right, and that's an industry-wide view. You're not just talking about Lazard specifically.
That's exactly, industry-wide. It's also important to point out, I think Lazard is kind of uniquely positioned here. We do offer share class ETFs in other markets. In the U.S., this is unique and novel, especially with respect to kind of Vanguard's earlier patent. we have a product in Australia that is a share class of a mutual fund. It's an ETF share class of one of our flagship strategies there. From Lazard's perspective, we evaluate each investment strategy uniquely and independently. We can convert mutual funds, which we've done. We can bring de novo strategies. And in markets outside of the U.S., we actually have launched share classes of existing funds.
All right, Rob, great to get some time with you. Really appreciate it on this Monday. That is Rob Forsyth of Lazard. Now, coming up, losing its competitive edge, Vanguard's unique ETF design is ready for grabs, and its rivals are ready to get approved. We're talking about share classes next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with this great chart on ETF launches year to date. Just stunning. You can see that in 2025, we're nearly at 800 new funds launched. And on Friday, as we were discussing, we saw more than 100 ETFs get filed in a single day. So if this pace continues, we could crack 1,000. Definitely something to watch. But related to that, let's take a look at leveraged ETFs. A lot of these new ETFs that have come to market so far this year have some component of leverage. And you're taking a look at the average day one turnover of those funds. You can see that it's nearly 30% so far year to date. There's only been 1 year where we've seen more turnover on the first day of trading. So definitely speaks to where this market is at. But let's talk a little bit about share classes. We've been teasing it all show, and that was the big news from last week, that the SEC has finally greenlit ETF share classes to launch of existing mutual funds. Dimensional was the first to get the green light. And Scarlett, it's hard to overstate, but also hard to put into context how important this is.
Absolutely. So let's get some more perspective and talk about this ongoing issue with Bloomberg's Emily Graffeo, who's been writing about it. And Emily, the thing I don't quite understand is that so many fund management companies already offer ETFs. So how does offering an ETF share class of an existing mutual fund change things?
So if you have a mutual fund that isn't going to be easily converted into an ETF, because we have seen a lot of conversions too, but if you have a mutual fund that, let's say, has a lot of shareholders in a retirement account, adding on that ETF share class is a way to make the mutual fund itself more tax efficient. And that's what Vanguard did. They obviously thought it was a pretty good idea because they patented it. And I think when we talk about just how important this is for the industry, just looking at the number of firms alone that have filed for this, almost 80 asset managers asking for this. That's more than 6 times the number of firms that applied for a spot Bitcoin ETF. And there was a lot of hype there,
I like
too.
that.
So just a week ago, Dimensional's co-CEO Gerard O'Reilly told us that they hope to have these ETF share classes available in early 2026. But then, of course, we were just speaking to Rob Forsyth. He's of the view that, operationally speaking, this industry isn't quite ready. What does your reporting say about that topic?
Yeah, so a lot of people have been bringing up the idea of these operational hurdles. Just to get a little bit more specific about what that exactly means. If you're a mutual fund firm that's never launched an ETF, you've never had to deal with, hiring an ETF head of capital markets, dealing with getting that market maker to come on. So a lot of firms we're talking about now are coordinating those relationships with market makers. Then a lot of firms are talking about just whether the broker-dealers, the platforms, are going to allow both an ETF class and an ETF share class on the platform at the same time, because that kind of creates some economic issues.
In this article, there's a phrase, the Y2K moment. It does feel a little like that, because it's like taking something from the old world and trying to connect it to the new one. Could anything go wrong here? Is there any downside here to trying to bolt on ETF share classes to all these mutual funds?
One could be that maybe the broker-dealers they're only going to allow the mutual fund class on. So if you are planning on converting all your shareholders into that ETF class, maybe you're not going to be able to do that. At least half of the issuers polled in a Cerulli poll actually said that the reluctance of the broker-dealers to accept the ETF share class is going to be a significant challenge. And again, just that idea of there's not balance sheet to go around to lead market make in 1,000 new ETFs. So if all of a sudden every mutual fund firm that's applied to this wants to create an ETF in one day. That's probably not going to be able to happen, but at least the biggest firms have likely lined up relationships already.
So there's a long list of firms that are trying to get approval from the SEC, including Vanguard itself, but it's for an ETF share class of an existing active mutual fund. What's the distinction here?
So Vanguard only has the exemptive relief to do dual share class funds with their passive, and they had applied for exemptive relief to use it in active funds several years ago. They didn't get that approval. So I think this shows just the switch up here with the SEC and how they've changed their tune.
Operational hurdles. That's what we come back to once again. Bloomberg's Emily Graffeo, thank you so much on the ongoing story here of the SEC approving the additional ETF share class of existing mutual funds. Now, still ahead on ETF IQ, we're going to drill down into Buzz with Jamie Wise of Periscope Capital and Buzz Holdings next. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at Buzz, which has been around for a long time. It actually got reincarnated in 2021, but this has been a thing in the ETF world for a while. What is Buzz? This ETF goes out and looks at all kinds of things on the internet for sentiment. Looks for the stocks that have people talking in a way that's positive, social media sites, news articles, and it puts all that together and gives you the 75 that are being buzzed about the most, if you will. 76 bips is the fee. As I said, it came out in 2021, but it had a little bit of a history before that. Let's look, the assets are 124, pretty good. Let's look at the holdings. Now, you might not be surprised here that you're going to get a lot of the famous Buzz-like stocks in here, Robinhood, Tesla, Supermicro Computers, Strategy, NVIDIA. So very Q-ish, little ARC-ish in here, so high growth, and that's why it's up big this year. Let's look at the performance. It is beating a lot of things this year. It's up 50%. That's how good of a year it is. And here I've got the Qs and S&P, and then that's Bitcoin. So it's really beating that. ARC up a little more. But I'd put ARC and Buzz sort of in the same bucket. This is definitely stock hot sauce, Katie.
Eric, thank you. Joining us now to talk about this ETF, I'm thrilled to say we have Jamie Wise. He is the CEO and co-founder of Periscope Capital and Buzz Holdings. Jamie, great to see you in person.
Thanks, Katie. Great to be here. Thanks for having me.
So when you come across an ETF like this, it's so fun to talk about the methodology because you know better than most that sentiment is fickle. It changes on a dime. So with that in mind, what does your methodology look like when it comes to staying on top of these trends? How frequently do you rebalance and things along those lines?
Yeah, it's a great point. Sentiment can change quickly. And when you think about sentiment, much in the way you think about volatility even, it depends on the time frame that you're trying to measure it. What the index does is it rebalances once a month. So it thinks about a little bit longer term sentiment. This isn't a high frequency, high turnover, capture the next tick or movement in the stock based on sentiment, but think more about a sentiment trend. And so what we're doing is looking across online platforms where people are talking about stocks from an investment perspective, measuring that conversation for sentiment, doing that over a month, and then aggregating that sentiment into the Buzz Holdings every monthly rebalance.
So you're basically buying companies that are in the zeitgeist, that have a lot of positive buzz around it. Does it matter? Does your technology make the distinction between companies that are kind of on the way up versus those that like have peaked and perhaps are,
It's really natural language processing. So it's what people are saying about the stock from an investment perspective. It's not overlaying anything more than that relative to are people positive about the stock and its prospects. And so it's not trying to overlay any kind of thematic or any kind of directional signals or stock trading history. It's simply based on the collective conviction of the online community.
When I look at the holdings here, obviously these are buzzed about stocks. How do you account for just the volume? Like everybody's talking about NVIDIA, it's the most traded.
Yep.
How do you get into some of the smaller names that might be positive? That way you're not just stuck with like the Qs.
Yeah, sure. So there's some thresholds around the index construction. So we should talk about that. So the index looks at all stocks that have a market cap of $5 billion or higher. There's about 1,500 or so of those stocks in the market today, but it's not every one of those stocks. We need to understand, and we really want to see that within those stocks, which ones are being talked about most frequently, most consistently online. You can imagine if the four of us are sitting around talking about a stock, but no one else is, the insight from that conversation isn't all that relevant. But if you can see that there are stocks that are consistently talked about by a large audience, then you want to know what that average or the overall aggregate sentiment is from that conversation. So we set up a quarterly eligible universe. So from that 1,500 stocks, we'll distill it down to somewhere between 200 and 400 every quarter, and that's the conversation that we drill into each month. We rank that conversation from most bullish to least, and the 75 make the index.
And so when you rebalance every month, does it start out as equal weight between these names, or how do you decide on how to actually weight the different stocks in the portfolio?
A great question. So we weight it by sentiment, and that's important because we think of sentiment when we started this 10 years ago. So the index has been live now for a 10-year period. We really thought of sentiment as a potential factor. So if you think of explaining security returns, we all know that there's growth and value, momentum and size and all of these other things, and everything else was alpha. And in that alpha bucket was sentiment. And our thesis back then in 2015 was if you can measure sentiment, you can actually strip out of that alpha bucket a factor called sentiment, and it can be its own unique thing. And so when we weight it, we don't want to market cap weight this index to let certain stocks drive it, like is in the case of the S&P 500, for example. So we cap each stock's weight at each monthly rebalance at a max of 3% to keep that diversification there. If a stock had a greater than 3% weight because it had a higher sentiment aggregate view, then we would just distribute the excess equally amongst the remaining constituents.
You're tracking positive sentiment. Are you looking to track negative sentiment? I mean, could you use this as a way to short certain companies as well?
You could, for sure. So the NLP measures sentiment based on what people are posting and talking about. That could be positive, it could be neutral, it could be negative. What Buzz is a representation of aggregate large cap positive sentiment. Of course, we have the data set of negative sentiment. We actually use this data set in some options related strategies within our hedge fund business at Periscope Capital. So there's lots of different use cases. Buzz to us is the ability to give back to the community the aggregate sentiment factor in its simplest beta form.
Does the computer ever pick up like sarcasm? Like, oh, this is the greatest stock.
Yeah.
And do you ever get false positives?
It was a huge challenge when we started 10 years ago because we had to build our own NLP to do this, right? So we're Toronto-based. We had a collaboration with U of T. We trained our models. That was a really difficult exercise 10 years ago, and then training them based on examples of sarcasm, and then all of a sudden emojis come into play.
Oh, no.
You know, with emojis in finance are very different than conversational emojis. You have rocket ships, you have all these other things. So continually refining and training and updating the model in those early years of Buzz. Today we have LLMs, and you can take any post, put it in an LLM, and the accuracy score of its sentiment, sarcasm, emoji, anything will be very high. So it's really table stakes, the raw data today. It's just the longevity and the understanding of what it is you're looking at.
All right, Jamie, got to leave it there. Great to get some time with you. That is Jamie Wise of Periscope Capital. This is ETF IQ on Bloomberg.